All right, so hey guys, how's it going? This is Luke and Paul here with Founded on Financials, and in this video, we're going to be giving you guys a really simple breakdown of what the fractal is, how to use it, and just the most basic layers of each component of the graph. So, Paul, if you want to go ahead.
So before we begin, we kind of want to define what fractals are because this is kind of a foreign concept to a lot of people. So fractals are shapes or patterns that are repetitive at different scales. We oftentimes see this in nature. For example, a good example of this is snowflakes. If you were to zoom in and view a snowflake at any point, you'd see a smaller version of that same structure repeated on and on for eternity. Some fractals are exactly self-similar, but most are statistically self-similar, like in the fractal application. So fractals in nature come from simple iterated rules that repeat over and over again. For example, a good example of this is the Mandelbrot set, which comes from applying one equation to points on a plane and checking which ones are bounded and which ones are not. Nature is filled with these fractal-esque patterns, whether it be in fern leaves, tree branches, lightning bolts, networks of rivers, blood vessels, mountain ranges, you name it. None of these are directly true fractals, as they do not repeat infinitely, but they do show the same pattern of self-similar branching over orders of magnitude. So how does the fractal system use this idea? Well, it follows a similar architecture as the Mandelbrot set, where it inputs stock price information and applies a set of simple iterated rules to it, which create statistically self-similar patterns across varieties of time frames and waves that aren't easily visible to the naked eye. So using this new lens as an angle to analyze from, a trader can achieve a more unique perspective on the plausibility of an underlying being undersold or oversold, which is incredibly valuable information for any trader. So the next component to understand about the fractal system is the basis of the wave system. To begin to understand what waves are to begin with, we first really must understand what the pivot line is. In this case, it's that giant blank line in the middle of the screen. So for a moment, I want you to imagine that every stock has a middle line drawn through its price history. This isn't a moving average or anything fancy. It's just a horizontal reference point, akin to like sea level. Price is either above or below this point, or also always crossing through this point. A wave, simply put, is just price leaving this point and then coming back. Price will begin at the pivot line, then goes up or down, sometimes a little, sometimes a lot, but eventually it will always return to the pivot. So how do waves and aggregations work together? Before any wave can exist, you have to decide what a single candle should represent on your chart. Whether that's 1 minute, 5 minute, 15 minute, 30 minutes, or even full days, this is what the aggregation is. A wave is built from those candles, so an aggregation will determine the shape of the wave itself. Think of these candles as bricks and waves as walls built from those bricks. A wall composed of tiny bricks can create a very fine, detailed wall. But with much larger bricks, that same stretch of time gets compressed into far fewer and much larger waves. The reason the system to begin with is considered fractal is because the same shape of wave behavior, which is leaving the pivot, wandering, and then returning, shows up whether your focus is on a 5 minute or even a 1 day aggregation. Zooming in or out shows that the patterns of smaller time frames exist within the patterns of larger time frames, which is really interesting. Another question that a lot of people have and ask about is, why would I use this system as opposed to another system, and what makes this unique? It's the fact that the system is nonlinear. In this context, in a trading context, linear implies that time runs from left to right on the x-axis, and price runs from up to down on the y-axis, with every data point or candle existing directly at its raw price value. Like, for instance, just a linear chart on TradingView is the baseline. If you want to interpret trend Through this, you can throw a simple moving average on top and call it a day. But the key property of linear or moving average analysis is that reference line, such as the moving average, is backward looking and mechanically smooth. So it's simply just math, adding up recent prices, dividing and plotting those results on a repeated scale. There's no knowledge of prior resistance, support, or wave structure that the fractal system has. The fractal system interprets the data in a nonlinear fashion. So instead of price being plotted along a simple standard chart with a rising and falling axis, it's instead projected along the central pivot line, with everything else, such as support and resistance, being measured relative to that pivot, not relative to the absolute price level. This distinction is engineered via the fractal vector, which responds to trader behavior patterns of buying and selling pressure, as well as support and resistance.
All right, awesome. So yeah, now that we're getting into the actual system itself, one of the biggest things that you're going to have to learn about are these little black lines over here, these dash marks. We typically refer to these as imprints or clusters, especially when they're together. So what you'll actually notice is these are simply just where all prior waves have peaked before reversing below or above the pivot. These are resistive and they're supportive. And when we see a cluster of them, it becomes stronger resistance of support because it's telling you that in prior history, the thicker the cluster, the more times that price has ended at that position. Okay, and so it's telling you where buying or selling trends have ended. So just for an example, looking at this wave 7 daily, you can see very clearly that over the past 200 days, our average percent band, which we'll get into shortly, inside of here, we have heavy clustering. You see we've got 1, 2, 3, multiple here, dash marks. That is telling you that if you look, multiple waves have been kept here. Now, what happens when we break out of this? We tend to get a much larger move. This is telling you that for the majority of the time, buying pressure comes to an end within this zone right here, and sellers end up taking over. And you can see if you go back in time on the amount of data that you have, each dash mark correlates to a prior wave peak. So, right here, there's two of them that are so close together you can't even tell that there's two here. But those correlate with that one. If you go way up here, there's one up here that correlates with this peak, which was H29. And then each one of these individual ones here correlates with its own imprint. And then same thing for the downside. So all that it is just the peak of prior wave cycles, telling you where buyers came in at the bottom or sellers came in at the top to end that specific trend on that time horizon.
All right. So another feature of the fractal system is the percent probable bands. And to explain this one, I like to explain it in a metaphor. So take a swimming pool, imagine a swimming pool, and there's a diving board that kids will jump off over and over again every single day from open to close. Every time a kid jumps, there's somebody there that measures how far they jump in the pool. So by the end of the day, you have a list of all of these jumps written down in order as they happened. Instead of viewing the order, take that whole list and sort it based on whether or not a jump is shorter or longer. Now we have this new kind of question that we can ask from this data. How rare is a specific length of jump? Let's say Billy jumped 5 meters into the pool and that was the longest one. You can analyze and see how rare a specific length of a jump is. So say 10 kids jumped today and then you sort all 10 of those jumps based on their length. The very longest jump of the day was only completed by one kid. So if a new kid comes along and jumps that far, you can honestly say that that jump is within the 10% of all jumps recorded that day. This is the basic principle of percentage probable bands. Take that same scenario of kids jumping off of a diving board, and we can apply it to the wave structure. Since waves are just journeys from price from the pivot to a stopping point, we can replace the how far a jump has landed with how far a wave has traveled from the pivot. When watching the stock move in real time and it's climbing, a natural question anyone would ask themselves is it even a big deal, right? Without our understanding of these percent probable bands, we'd be guessing based on feelings, With these percent probable bands, we can actually point to a concrete statistic and understand whether or not a move above or below pivot is statistically significant.
Perfect. So
And yeah,
now,
that's pretty much.
also getting into while we're talking about percentages, if you'll notice on the side here, you see that we have a line of percentages that increase as we go up, and then also increase to the downside in negative terms over here. Now, what that is these numbers are telling you percentages from that pivot. So if you go ahead and take that 9%, it gives you the price value associated with it, 740.88, and it gives you the number $64.04 from the pivot. So if you check that math, that will come out exactly right on the money. Now, this is just telling you how far above pivot. So 9% above pivot is 740.88. And that's from the anchor price. Okay, so price anchors to that pivot that Paul was referring to earlier, and then it gives you a value above or below. And you can actually see how much a stock moves up in a sequence compared to down, or vice versa, by looking at the percentage value for where price tends to move. And if it's above pivot, often we hit, let's say right here, we often hit the 7% right here. You can see that's kind of where the make or break is on this specific aggregation wave combination that we have. And above there, it's very rare and it's kind of an outlier. So 7%. Now, what does it mean for the downside? That same kind of area comes out to around 4.1. And actually, let me just reiterate this just so it makes a little more sense. Let's use the average percent moves here because it's the same amount above and below. So the average move above is about 4.4%, and the average move below is around 4%. So a little bit less. So it's basically telling you that the upsides tend to be stronger than the downsides. As you can see over here, 9%. And even at the most extreme, we have 15%. Whereas up here, our most extreme was 27%. So you can kind of see, how often, and I mean, if you change the ticker as well to try and give you some real-time examples, let's just really quick pick a stock so like this, like Oracle has been really volatile lately. It's approaching its 36%, which is where 2 prior cycles have ended. Maybe this is where it ends this cycle, up near this open state. Okay. And as below, we've been getting down at a max to around 26 to 23 compared to 36. So the upside has been much stronger than the downside, which is going to be typical for most stocks. Now, the next thing we're going to take a look at is the macro trend. And the macro trend is going to be right here at the bottom. You can do this right here and hold it with your mouse and pull up, and it'll zoom it. So this is the macro trend. It's even labeled for you. So this is a band at the bottom of the graph that simply shows either red or green. If it's green, it means the overall trend is long, regardless of whether price is below or above the pivot. And when it shows red, the overall trend is short, regardless of whether price is above or below the pivot. The level that determines when it flips from this red to the green or green to red can be seen by hitting the linear chart button. So take the fractal graph off because otherwise it'll be a little bit complicated looking. Okay. And once you do that, not only will you be able to see price in its linear form, this is linear, not in our fractal form that we typically look at. You'll see an orange colored line that is similar to the vector. It's right here. And if you look at it, if you're above it, the macro trend is green. And if you're below it, the macro trend is red. And so a common trade using this macro trend, before we do that, just, you can kind of see really easily we're green this entire time, even on pullbacks. And then we finally break below, tells you macro trend is red, overall trend is red. Same thing here. Even though here you were above the pivot, or the vector, purple vector, you were still below that orange macro trend, and we continued short. Now, one of the really popular trends that we use one of the common trades is a macro trend is shorting the average percent line above pivot when the macro trend is red, or longing the average percent line when below pivot when the macro trend is green. So this will almost always net you more winning trades than losing trades just by using proper risk management and being consistent. And you can kind of see what I mean by that. So if you're looking at this, when you are in a red macro, your upside has more probability of being capped inside this average percent band, with the downside having a higher probability of breaking that average percent band. And then it's vice versa for green. If you're in a green macro trend, you have a higher probability of breaking the average percent band to the upside and a lower probability of breaking it to the downside. So that means in a green macro trend, if I'm down near the bottom of this average percent band, I can begin to look for entries back long. And if I'm at the top of this average percent band in a red macro trend, I can begin to look for opportunity short. And sometimes it will flash a color, and sometimes that can indicate that a change may be coming. But a lot of times, if it remains that color, then that is what you go with. So perfect example is right here. We're a red macro. We get up here towards the top of the average percent. You take your entry, and you get a strong short that exceeds the bottom side average percent. And if you want to see the opposite be true, you are in a, let's see. So you're in a green macro right here. You enter long at the average percent band because you're in a green macro. And even though you don't exceed the average percent band above pivot, you still get a solid return because you got that return above pivot to the top average percent band. It just means that when you're above, you have a higher probability of breaking that average percent band. Now, that leads into what are the H and L values. So I like to explain this one on the Wave 1 Daily just because it's very granular, and I think it does a good job. So H and L values are simply a count of how many aggregations it took to reach a peak or a trough. So if a move above pivot on a Wave 1 Daily chart has a 4H assigned on top, similar to this right here, then it took 4 daily aggregations to reach that peak, or 4 days. And that's 4 trading days. So we're not counting the weekends in that. So the L values work in the same exact way. It's a way to classify from a time perspective how likely a move is to continue before reversion. And if over 200 days we have only exceeded an H4, say one time, then it's highly probable from a time perspective, not a price or how far above or below the pivot you are, but simply from a time perspective that we will revert and form an L1 or vice versa and form an H1. And these are stats you can pull from the option analyzer. So if we pull the option analyzer, and I'm going to just kind of do this so that you can see the graph and you can see the stats. We can see that when we're on an H4, we have an 8% probability of continuing. There's only 4 occurrences, 2, 1, 1 of us continuing. So we know that we have a high probability that we aren't going to continue higher. It's possible, but it's an outlier. Outliers do occur, which is why we have to have proper risk management. But then you can also take other things into account, like in this case, we weren't just overextended on a time perspective. We were also overextended from a perspective of how high above the pivot we were. We were overextended from a price perspective. And now what I actually had an example from earlier, I think that would work. It was gold futures. Yeah, so here. This is an exact example where maybe it plays out tomorrow, maybe it doesn't, but it's worth taking a chance. So on gold futures, today we formed an H4. We can see that over 200 days of data loaded, we've only exceeded an H4 once, and it formed an H8, which is an extreme outlier. Based off of that, we know that we're highly probable to form an L1 tomorrow, which means that anything above the previous day's close is considered a discount, and we can look for an entry short to play back below for a daily close below that prior day's close. And you add in the probable percent bands that Paul was talking about, and you notice, hey, we're actually at the 10% band as well. 10% band is usually a good area for reversion. Not only that, we have an open state right here that we didn't quite close, but we're right there. So you have a lot of confluence here. But the main thing to show here is just the time perspective here. You're getting to be in an outlier territory. Now, the next thing is, what is an open state? So open states are peaks of prior wave sequences that have not yet been hit since they have formed. So they also create a black imprint on the right-hand side. So everything that is an open state or was an open state and was closed, like right here, forms a black imprint on the side over here. Okay, and so these are great for targets as well as potential reversion points. And the number next to an open state tells you how many aggregations it has been open for. So like right here, this is 7. That means that this has been open for 7 trading days. Up here is 81. This open state has been open for 81 trading days. Okay. And so an open state is open only until the price has hit or exceeded that level. If we gap up above it, an open state, because some people do ask this, it is still considered closed. We just need price to exceed that open state. So open state values change when the pivot changes. And open state, so like an open state value of say $15 above pivot in one cycle will be different in the next cycle above pivot. And this is just because of the nonlinear factor of the fractal graph. And the value of the open state adjusts as the price that is anchoring it does. So let me show you just a quick example of that by using this little button right here. And I guess we can just really quick cover that. So there's just a couple buttons. This one on the left just pulls you from the right to zoom in. This one does the opposite, pulls from the left to zoom in. And this one in the middle just moves where the graph starts. So just so you guys understand that. But now that we've done that, I've pulled this back a few days, and now watch. So right now in this open state from a week or two ago, this value of this open state was 770.45. Notice now we're below vector. We printed an L1. That value is now 835.15, and that's based off of the vector price right here, 717.30. So this value adjusts with the vector, and as soon as you flip above pivot and the new pivot is stable, that value will become stable. So 832, it lowered because our value of our vector did. Now we've printed an H1. See how it's still 832.06? That's because this value right here, if you'll notice, the vector was 714.65. That now becomes the pivot value. The open state remains the same. But you can see as we continue, until we hit that, as we revolve, it changes that open state value. But now we're at an H1. So if we were to hit this in open state in this cycle, the price would be 836.48. And that, again, that just has to do with the nonlinear proportionate of this. I think that's pretty well that for that.
So moving on, we've been talking a lot about this purple vector. So why don't we explain actually what it's doing. So moving averages answer a very, very simple question that anyone is able to answer, which is what is the average price over the past X days? This approach is really descriptive, but it's not very evaluative and doesn't accurately judge whether buyers or sellers actually did anything at this price level. It doesn't really tell us if it means anything. These moving averages treat every data point equally with no room for interpretation, which is where the vector comes in. The vector line does something entirely different. It's not really just describing where price has been. Instead, attempts to track where crowds of traders have repeatedly defended or failed to defend specific levels. So, in itself, this vector is attempting to answer an entirely different question based on everywhere buyers and sellers have fought over a price before, who actually has the upper hand in the scenario. And that answer relies on a cumulative history, all centered around this pivot. But who really cares? Who gives a damn? And what's the point? The payoff of using this vector system lies in a deeply rooted issue that a lot of traders struggle with, that being trend identification. The vector line encodes something that raw price data cannot do on its own, which is if underlying pressure has actually shifted a specific way. The vector is designed to separate the signal, to separate a signal from actual noise. And I believe Luke has a great example for this. I think he's already looking at it himself, which is the pivot resets.
Mm-hmm. I can see if I can find, let me see, I believe I can find an example of that for you.
Or we could do counter trend reversals, things of that nature. Or like a bounce off of support or resistance, but a failure to break the vector.
I have an example. There you go. Do you want to explain it, or would you like me to?
I think you should run through it. You got the next one to talk about.
Okay. So just to go along with what Paul was talking about with that vector, there is a specific pattern that we identified that basically tells you that, whoa, 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 either don't count buyers out or don't count sellers out. In this specific case, the pattern is don't count buyers out. And that is the system identifies when sellers are essentially, or buyers are trying to come in, but then the other side of the transaction basically says, whoa, we're not done yet. And what I mean is, if you'll notice, in this pattern, the vector comes up, we get below, both price and vector reset to the pivot, but we don't get an L1. This is not a super common occurrence across a single stock or wave aggregation, but you'll find it fairly common enough across multiple tickers and across multiple wave aggregation combinations. And you'll see when this happens, usually I like to see 1 to 2 candle confirmations and then take an entry. And we actually did take this entry the other day, and it returned to well over 100% right off the morning on Hood. That's what this is Hood is in Robinhood. And basically, if you look, if I put my cursor right here in this wave, even though this is the same wave, if we make a new high, it's not going to be 1, 2, 3, 4, 5. Tomorrow's not going to be an H5. It's going to be 2, 3, 4, 5, 6, 7, 8, 9. It's going to be 9. The H count remains the same because it's the same wave. But the value on the right, where these percentages are, resets. Because if you see, we go from 93.92 to 98.08, even though it's the same level in the same wave. So that's a bullish indication. And we get that same pattern to the downside as well. And we have other stuff on there as well. So if that's something you guys are interested in, just shoot either of us a DM and we can definitely go more into that. But now the next part of this is, what is the pivot? Okay, we've kind of talked about it a little bit, but what actually is it? So the pivot is this black line that runs through the center of the fractal graph, and the value is given to the right of the graph, right here. So pivot, the current value for the Wave 7 daily on QQQ is 676.85. So this dictates when price is long or short. When price is above this pivot, we are in a long cycle, and when price is below the pivot, we're in a short cycle. The value of the pivot changes when price flips from below to above pivot or above to below pivot. The new value is the most recent value of the purple vector. Again, the last couple things I just said, we already mentioned, but I just kind of want to include it that we're specifically talking about the pivot now. And so if this pivot were to be a fixed static line, it would never adapt as new waves complete and new information accumulates. It would just sit there, disconnected from what the changing market landscape is actually doing. And instead, because the pivot is an anchored point in which every wave measures itself from, the system remains self-referential and current. And so each new wave that is completed doesn't just add a new data point, rather it reshapes the structure that the next wave will be judged against, and the frame of reference in turn evolves as new data comes in rather than staying fixed. And so, I can show you that same example of what I did on the Wave 1 daily earlier, in that, you can see that as the value of the pivot changes, it's taking on the form of the most recent vector value. So 714.65 was the most recent vector value on the Wave 1 daily. We get an H1. The new pivot value is that most recent vector value, 714.65. And that goes on any time frame. The pivot just becomes the most recent purple vector value before flipping. Okay. And now the next part that I want to kind of go over and cover is, what is the standard deviation feature? And this is really helpful. And actually, looking at the Wave 760, we can even see an example of this potentially coming up for the next trading session. So this feature is at the bottom of the graph below the macro trend. We have our macro trend here. This is our standard deviation. Okay. And it's an indication of when volatility is squeezing or compressing, or in other words, contracting or expanding. And when it gets into what we refer to as the golden zone, which is this little yellow zone down here that you see where it says standard deviation squeeze, then we know that we're heavily compressed and we're likely going to see some type of expansion of volatility in the near future. This is typically the best time to enter positions, especially for long options traders, as we want to see volatility. And the standard deviation band is colored green when it's above the purple vector and red when below the purple vector. you'll notice, you can see that that's how it's colored. We were green this entire time as we were above. Right here, we flip below the pivot, or the vector, and we turn to red. So this is colored by vector, not the pivot. That's important. Okay. And so there are levels on the right that show how far it is expanded. Like in this case, 0.8, 1.5, 2.2, 0.5, 0.1. And we can see where the line often reaches a peak and begins to curl back down. And this can often mean the peak of a move or volatility has been achieved, and we can begin to head back towards our golden zone, which can a lot of times lead to compression or consolidation in price action on that time frame until we reach back to that golden zone as price has to cool off. And so we can identify patterns like trend lines in the standard deviation as well. And sometimes you can kind of see that. There's not really a trend line specifically in this one that I'm noticing, but there are sometimes ones. There are other examples of that. But when an M fires off, it means we're trying to expand short. So that's important. The actual standard deviation being in the squeeze zone itself does not signify at all direction. There's no direction associated with that. It's simply a marker of volatility. The M and the K, however, are an attempt to try and dictate which way that volatility is going to unfold. So if the most recent one is an M, then that means we're trying to expand to the downside. If the most recent one is a K, that means we're trying to expand to the upside. If we get an M and it flips to a K, that can sometimes be a signal as well that we're going to expand to the upside and vice versa. Okay? And so let me see. Yeah. So, if we want to just kind of look at an example, it may be easier to see this on a daily. So, yeah, you can see right here, we were in the squeeze. Right here, the most recent signal we had printed off was an M. We're down in the squeeze. And what do? We get a large expansive move down while in the red macro, below the pivot, 2 bearish signals. The standard deviation band is red because we're below that vector. And we continue to expand in volatility. And what happens when we reach our 1.6 line, where you can see once we get into this 1.6 to 2.2 area, we tend to peak on trends. We hit it right here, and we can see that our move pretty well ended and headed the other way. So that's another thing. Just because we're pulling back down does not mean that you can't see volatility come in. Just typically we seem to see compression until we get back down here. And the most volatile moves tend to come from this expansive zone. You can see that again right here. We get an M print, we flip to a red macro, and we expand out of there, and we get a strong push to the downside. Now, what is a double bottom? Now, there actually is one on the Wave 1 daily right now, so this is perfect for me to give an example. So a double bottom is an open state below the pivot that the fractal system detects, and it has at least a 51% chance of being hit when populated. So it's slightly better than a coin toss, which doesn't sound like much, but anybody who's familiar with statistics, or if you like blackjack, things like that, you'll understand that the house edge in a casino, like in blackjack, it's not much. It's anywhere from 0 to 4%, somewhere in that range. And that 1% in one instance doesn't mean a whole lot. It could be pretty random at one instance, but over a long time horizon of attempting something over and over again, that 1 to 2% area, you're going to come out on top. And so that's important. Now, however, strictly from observation, just from using the system for so long, and I've discussed this with other people such as Milk, it appears that these double bottoms are achieved much more than 51% of the time. And we were actually talking about how it seems like they hit roughly around probably 70% of the time. Now, that's not been actually statistically back tested. That's just our guesstimation on what it would roughly be. So these are really useful to use, and they're great targets when they do populate.
A common misconception with the fractal system is how 2 price points can exist on different points of the chart at the same time. And this is simply just because the system is not linear. In a linear system, a price level just is what it is permanently, but in this system, nothing is really evaluated against a fixed scale. Everything from resistance to support to the percentage bands is evaluated relative to the pivot at the time in which each wave occurred. So this pivot isn't static. It shifts as new waves complete and reshape the structure. And Luke has graciously found an example here. Show you, see how price 713.44 exists both above and below the pivot at the exact same time. Just be aware that if you want levels accurate to your current wave, you must be plotting with that in mind and focused on your wave directly. So if, for example, Luke, if you were to hover your mouse over to the prior wave, you'll see that not that wave, the wave prior to the most recent wave, you'd see that even in the same position, if you just swap across when the pivot changes, the values change entirely. So just be aware.
Yeah. And yeah, I think, you can kind of see it in two different ways. Like one in this wave right here, you're 713.44. And way back on this wave, even though you're below pivot, you were also at 713.44, 713.50. It's right there. But you can also, like Paul was saying, at the same price point, be above or below and have the same value. So like right here at the exact same level, vertical wise, we have 711.03. Well, above the pivot, right here, we have 711.26, which, if it would put it exactly at 711.03, I would show you that. But you can see the values existing above and below. So that's important. Now, moving to the last thing, how do you pull the ceiling, floor, PML? What are they and how are they derived? So the first thing you're going to do is pull up the option analyzer. Now, real quick, there is a fast button to do it. You can press it like hold on. Usually if you're going to press the button, you want to have it on like the 1015 or 760 or something. You can press this and it'll show it quickly, but the better thing to do is to right click your mouse, click option analyzer, and on the bottom right, click the load. This will load all of the options contracts. So you want to load the next day's close to expiration. So August 12th is today and that's already gone by. So you don't want to use that data. That'll reset at midnight. So this line right here will go at midnight and this will be the newest one. So August 13th is what we want to click. And then you're going to click the calculate market maker move. And it's going to take a second and then it'll load the market maker move graph, which is going to show the ceiling, floor, and PML, as well as the market maker dead zone. And these levels are derived by synthetically trading the options chain and the underlying equity up and down millions and millions of times over. And so the PML stands for peak money line. Okay, there we go. So this is the chart. The PML is right here, this red line, peak money line you can see. And this is where market makers stand to lose the most money, where they have the most exposure. They want to move away from this. Now, above the PML, we're bullish and we usually target the ceiling. And below PML, we're bearish and we usually target the floor. The ceiling and floor are market makers' desired locations to bring price, as that is where they stand to make the most. However, when we exceed the ceiling or floor, we enter what's known as positive exposure. And this is where market makers have incorrectly priced everything. And now we have to hedge to cover. Well, they have to hedge to cover. And this can cause a quick +1 to +2 in premium to be tacked on. And it doesn't happen often, but most often when it does occur, it's on Fridays. And so the last part of this is the market maker dead zone. And this is where price can stall out and become consolidated, as market makers like to keep it here to burn premium off. And this is bad if you're long a call or a put. And because they're typically on the other end selling calls or puts, that's why they want to burn that premium off. They want to capture the most premium that they can. And this can oftentimes be used as a pivotal zone and is great for entries or exits on positions, which is why you usually see it on most of the charts that I send out. And you can see it works day in and day out. And then over here on the left, just to cover what this is right here, is it's showing you each price level that's on this chart. It's showing you the associated exposure. What is the most optimal contract for that? The buy to open, percent gain, the sell to close. Now, we're not going to go too much more in depth on this. We just wanted to give you a basic view of the market maker move, because a lot of you are more familiar with that than the fractal system. And you can actually pull these data points. You won't get the market maker dead zone, but you get the ceiling, floor, and PML from the OMM, which is what a lot of you guys pull it from. And this is a static level overnight. I usually chart these, even though they adjust during the day. These levels are really great to keep in mind. Okay, so you can see one last thing. The highest exposure number is right here. $126,199,600 is what they stand to lose if price were to close at 724.42, which you can see is the peak money line where they stand to lose the most money. So I think that covers pretty much all of it, Paul. Do we have anything else?
Not that I think.
All
That's
right.
good. Video.
Awesome. All right. Well, thank you guys for joining in. And yeah,